IVM.
BQ Big Decisions, the BloombergQuint podcast that helps you make the right financial choices. Investing is good. You've heard this, of course. And you've probably also heard that investing in equity is a great idea when you're trying to achieve your long-term goals. The thing is, gains in the equity market are seldom linear. It's quite possible that you've held an equity portfolio for 5 years and most of your gains have come in the 4th year. So the question I'm asking today is, should you have a targeted return in mind when you invest? This is BQ Big Decisions, and I'm Alex Matthew. I'm joined today by Harshvardhan Roongta, certified financial planner and founder of Roongta Securities. Thank you so much, Harsh, for joining me today.
My pleasure, Alex.
It's a bit of a nuanced conversation, this one. Normally we say that you should just identify your financial goals and put money in, because invariably over the long period of time you have a return that the market will give you and you will achieve your goal, isn't it?
That's right. So the way that we plan for investments and for our goals in future is that we a goal that we need to achieve over a period of time. We quantify that goal to say, I need X amount of money after, say, probably 15, 20 years from now.
Yes.
And then we work backwards. We assume a rate of return that a product will give,
yes,
to ascertain and to determine what is the amount that I need to invest every month for that.
And that is a factor of the risk that you're willing to take, and also how negotiable your goal is, right?
Absolutely. So in case you're not willing to take a lot of risk for that sense, so then you'll have to invest in something that is safer in nature and will also give you lesser returns.
Sure.
And if in case you're willing to take a higher amount of risk, then of course we will exploit that investment that you do at a higher rate of interest, higher rate of return rather, and then ascertain what is the corpus going to be accumulated. So yes, the choice of product that you invest into will largely depend on what your risk profile is, how non-negotiable your end goal is.
Yes.
So it will depend on all those factors.
I must point out here that we have done conversations about goal-based investing and indeed about risk profiles and how they determine how your investment should go. But this is not a conversation that we're having today. We're talking about whether or not. So assume in a certain situation, Harsh, that I have a goal that is, say, 5 years away. Okay. And I've built it into the portfolio, right? I've said that I need a return of about 15% over a 5-year period, and I put a lump sum in. I want to know at this point, should you have a targeted return in mind when you put a lump sum in and you pull money off the table when you hit that mark? Because I think for a lot of retail investors, that we have spoken to on BQ Portfolio and various other platforms on BloombergQuint, the question is, should you wait because next year you could get a similar or better return, or should you take the money off the table?
See, well, Alex, if you're investing into equities, you must understand that equities do not give you a linear return that we just spoke about.
Yes.
It does not give you a fixed deposit kind of a fixed rate of return every year.
Yeah.
So in case you have estimated that I will generate a 15% return annualized over the next 5 years, does not mean that you will get 15% every year.
Sure.
There could be an instance where you will get, say, flat returns, and no return in the first year, a negative return in the second year, and a bumper return in third year.
Yes.
Again, a flat return in the 4th year, and the 5th year you will get a moderate return.
Sure.
The average of this cycle is if 15% you've achieved your target.
Yeah.
That's how equities will be.
And that's why you have to have a longer period in which you invest in equity.
Absolutely. So equity investments are always going to be sporadic.
Yes.
They're never going to be linear.
So the question is, should you have a fixed return in mind in percentage terms when you do invest?
See, while you're investing, if you have a goal in mind and you've quantified that goal, hypothetically, let's take an example. You want a corpus of 50 lakhs after 20 years.
Sure.
Now, if you were going to assume that I'm going to invest in equities, and you're going to also assume that equities over a 20-year period are going to give me 14% returns, annualized, a CAGR return is going to be 14%, then you would do a backward calculation to ascertain how much you need to invest today.
Okay.
So that amount works out to be about 4,000 rupees every month.
Sure. So we're talking about an SIP here. We're not talking about a lump sum.
No, we're talking about SIPs.
Sure.
So what you're doing essentially is saying, if I invest 4,000 every month, if this grows at a rate of 14% annualized, I will accumulate 50 lakhs after 20 years.
Sure.
Now, the underlying assumption over here is that the returns over a period of 20 years will be 14%.
Sure. So in some, and that's also taking into account the fact that some years you might get negative returns, as we've seen in the last 3 years.
You will most certainly over the next 20 years have negative returns over any period. I mean, you will have that period. You cannot assume that I will have a one-way growth over the next 20 years. So there will be certain, number of years where you will have negative returns.
Sure.
So I'm saying all put together, the average return that you generate over the next 20 years
will be 14%.
Say about 14%.
Sure.
Now, the only downside of this assumption is that what if you don't even get 14%?
Okay.
And we're talking about these returns not being visible to you every year in any case.
Correct.
So assume you're again in the, out of 20 years, you're in the 18th year. And now that you've done an average calculation of what is your IRR, and that works out to be about 10%.
Okay.
Then what do? Your assumptions have gone horribly wrong.
Horribly wrong, yes.
Now this could jeopardize your end corpus by a large amount of money.
In your example, have you quantified that?
Yeah. So let's put it like this. If you were to invest 4,000 rupees every month, grows at 14% annualized, would become 50 lakhs after 20 years.
Correct. At 10%?
At 10%, this entire end corpus reduces to 30 lakhs.
Oh, so it's a major difference in the end corpus that you generate.
Absolutely. So this could possibly, although everything has been good, you've been disciplined with your investments, you've stuck to equities irrespective of the market cycles.
Yes.
You've been 18 years into the investment and suddenly you realize, I was assuming 14%, but it has become 10. And if in case your goal is non-negotiable, then what do? Where do you arrange for that 20 lakhs in the last 2 years itself?
So what you're saying is that while it is good to have an assumption and a targeted return, it's not something that is foolproof. But is there another method that you can follow?
Yes. So most certainly this is not a foolproof system that we all know, because there are a lot of assumptions in any calculations.
Sure.
So in case, now let's talk about another investor type. If there is an investor who says, I need 50 lakhs after 20 years and I don't care how I get it.
That's non-negotiable.
It's non-negotiable.
Yeah.
I don't want to be dependent on market returns. I want to make sure I get 50 lakhs after 20 years.
Yeah.
Now, how he could go about doing this? So there is a solution for every problem.
Yeah.
So
I thought you'd have one.
Yes. So the idea is that if you need 50 lakhs after 20 years, you simply divide it by 240 months.
Okay.
So it works out to say round figure 20,000 per month.
Okay.
So we're in November 2019.
Yes.
Your intent should be that you omit that calculation of returns completely out of your equation.
Okay.
You simply divide your 50 lakhs by 20 years, which is about 20,000 a month.
Okay.
You invest in November 2019, you invest 20,000 rupees.
All right.
In December 2019, whatever you invest in November, suppose that 20,000 becomes 21,000 rupees. So in December, now you will put in only 19,000.
Okay. So it's a flexible SIP, if you can call it that.
Correct. But it's value oriented with every month.
Okay.
So essentially after 3 months, you should have 60,000 worth in your investments.
So equally in the third month, like you said, you should be at 60,000. If you're actually at, say, 58,000, then you need to make up the balance.
The only 2,000. Then your investment in the third month would be only 2,000 rupees.
Okay.
Because you put in 20 in 2 months.
Yeah.
That is grown
No,
to
what I
about,
meant is if with that 20,000 that you're supposed to put, you're at 40, that you're at 58, you need to actually be putting 22,000 and not
correct.
20,000.
So let me enumerate this with an
Sure,
example.
sure.
So November 2019, you put 20,000.
Sure.
In December, this 20,000 became 21.
Yeah.
So you needed 40.
Yeah.
So you
need to
put in
90.
only 19.
Yeah.
In the third month, this 40,000 that you've put in November and December together becomes 39,000.
Okay.
So then you will put 21,000 as an investment.
Okay.
So this becomes 60,000.
You're right. Yes.
At the end of 3 months.
Yeah.
So like this, every month you will just make sure you have a multiple of 20,000.
Okay.
Now, if you compare this, so in scenario 1, we had said that 4,000 a month growing at 14% achieves 50,000. In this example, we are putting 20,000 a month now.
Yeah.
So it's 5 times more that I'm putting.
Yes.
But this is the initial. So in SIPs, you will see the fund value being very less initially and becoming large towards the end of the goal.
Yes.
In this case, you will find this fund value to be constant all throughout your 20 years.
Correct.
Now your SIP amount, the amount that you invest every month, initially will be very large because we're not incorporating any returns into this. But over the years, this amount will keep reducing. So 20,000 first year, first month rather, 20,000 the second, 20 in the third, fourth. When you cross 5-10 years, then this contribution will come down because the fund value would have grown.
Because you've essentially front-loaded your investments.
Yes.
Okay, so you front-loaded your investments, and that entire corpus will get the benefit of that big spurt whenever that big spurt does come in the market.
That's correct.
So you have a situation, I'm sure, where in a particular month you may not even have to put.
Absolutely right. So there will come a time wherein you might not need to put anything beyond a point, because your existing investments are generating that kind of return for that particular month at least.
I would assume, obviously, if you're following this, then that at the end of your targeted time, that is 20 years, come what may, you will end up with 50 lakhs.
Yes. So this is the essential point that we're trying to address.
Even on the upside, you will come
upside or downside, you will get 50 lakhs after 20 years, because you made sure that anything short of 20,000 into the number of months, you've contributed it yourself.
Right.
So for all those who need an X amount after a particular time period, can invest into this methodology.
Yes.
And make sure that you have 50 lakhs after 20 years.
So it's an interesting concept, I would think, Harsh, because I think you can actually be a little more flexible in terms of what you do with the excess. If you generate an excess, you can perhaps take a little bit more risk with the amount that gets left over, take a slightly riskier bet in the market that could potentially net you a higher return, right?
Yes. So in this example of a variable amount that you invest every month, post 10 years or 15 years, you will notice that you will need to only invest probably 2 or 4 or 5,000 per month.
Sure.
So at that point in time, you will have more surpluses available to take risks if you want to, or do something else with that money.
Yeah, because you have most definitely, and most people will agree to this, you have more financial goals than you have money.
Absolutely.
And you obviously have to prioritize them.
Yes.
So this would free up more money every month for you to achieve those additional goals.
Post at least 10 or 15, 10 to 12 years. So initially, as you said, it's front loaded. So initially the contribution will be larger. But as the corpus grows, and it also generates returns on its own, then the contribution of 20,000 will start falling.
So a very quick question in terms of the instrument that you choose. Of course, it's a factor of the risk that you have, and the risk profile rather that you have. But you would advise in a situation where it's a long-term goal, you still put it in equity, right? 20
years, of course. I mean, if you're looking at a 20-year time horizon, there is no way that you will invest into recurring deposits.
Or debt for that matter.
20 years, not even debt for that matter.
Because debt would be significantly less volatile in that sense.
Volatile, yes, but then the contribution will be much more.
Yes.
If you're looking at a 7% or an 8% kind of returns against a 14 to 15%, I mean, the contribution amounts will be larger.
Sure. I think that's a very interesting concept. So I think to sum this conversation up, Harsh, do have a targeted return in mind, especially when you have a lump sum. And I guess it makes sense to pull money off the table at that stage because you've achieved your goal, so to speak.
So you're asking about if a person has invested into as lump sum.
As a lump sum, yes.
And has a 20-year time horizon.
No, not necessarily a 20. So suppose you want to buy a car in 5 years, okay, and you know that you will need a certain amount of money, say 10 lakh rupees, and you've put in say about 5 lakh rupees, thinking that over a 5-year period or a 6-year period in the equity market, you will generate a certain amount of return.
Correct.
And if you, in a particular year, say in the 4th year, you've managed to achieve that target, you pull money off the table.
Yes. So in all cases, in case your returns are going to be variable, basically your targeted sum is dependent on the returns that you're generating.
Yeah.
Like an assumption of 14%. If you've achieved that targeted amount 1 or 2 years prior to the date of you requiring the money, then in most cases, yes, you have to remove the money out and secure that.
Correct.
Because you don't want a surprise to be affecting you in the last year of your requirement.
And in the other case, where you're doing an SIP every month, if you don't want that surprise to play out at all, you do the variable SIP.
Correct. And in that case, you don't need to pull the money out because you're anyways filling in the gap. in the difference of returns that the fund is generating. So in that case, you don't need to really worry till the last, because you simply divided the 50 lakhs over 20 years.
So the small caveat is that it's a little difficult for people who are just starting out in their careers, perhaps because it would require a slightly larger amount of money that is invested every month.
Correct.
But if you do have the capability, and if you know that you will need a certain amount of funds in, say, 20 years' time, then it makes sense to go about it.
So in that case, in fact, you will see the other way around. It's as front-loaded. The investments in the initial years are higher.
Yeah.
And will reduce later on.
Yeah.
So this works again for people who have no responsibilities and no liabilities now.
Yeah.
So if you have no liabilities, might as well invest more. And later on, when you start having more responsibilities, children, family, other goals, then you will need to reduce your SIPs. So this automatically reduces the SIP in that sense.
That's good. And I would think this is another way to buy at the bottom and to sell on the top.
So this automatically affects that. So whenever the fund value is higher, you're investing less.
Yes.
When the fund value goes down, you're investing more. So this buy low and sell high.
You're automatically doing
this.
Yeah.
And the beauty of this system, if you can manage, is that it removes the variability on the returns factor completely.
Yes.
So whatever the return, so what if my fund is not generating 14%, which I estimated, I don't get a surprise at the end of the tenure.
And while we have spoken about 20 years as an example, you can actually bear this out, I'm sure, in any time frame.
Yes, of course. You just have to simply divide the number of years that you have by, suppose you want something after 5 years, you divide it by 60 months.
Without taking into account any
returns.
Yeah. All right. I think that more or less sums up the conversation that we're having on BQ Big Decisions today. Thank you so much for joining me today, Harsh.
It's a pleasure always, Alex.
And to you, dear listener, I hope that this conversation helped you out. It's a bit of a nuanced conversation, so do let us know what you think in the comments section on any one of our social media platforms. For more in the personal finance space, do watch out for BQ Big Decisions every weekend, and of course for BQ Portfolio. Thanks so much for listening. This is Alex Matthews signing off. Have a great weekend.
If you enjoyed Big Decisions, check out some other podcasts on the IVM Podcast Network. You can check out Paisa Vaisa, hosted by Anupam Gupta, Advertising is Dead, hosted by Varun Dugirala, the Ronnie Screwwala podcast, hosted by Ronnie Screwwala, or Cyrus Says, hosted by Cyrus Procha. These shows are available on the IVM Podcast website, app, or wherever you get your podcasts from.
Are you constantly seeking happiness? Wondering how to make the most of every day? How not to let your inhibitions stop you from achieving your goals? It's now time to get your A game on. It's time to unlock your true potential. Tune in to the Empowering series with me, Zarina Poonawalla, to feel empowered in all genres of life. From behavioral skills to management skills. From health to relationships. From mental well-being to emotional well-being. And of course, your finances. I've got you covered. With these tips and tricks from me, Zarina, and true life stories from my amazing guests, you're bound to bring your purest to the table. Tune in to the Empowering series with Zarina Poonawalla every Thursday on the IVM Podcast app, website, or wherever you listen to podcasts.
This is the amazing story of something awesome. Once Chuck decided to start a podcast, and so he did. The end. Okay, that was a crappy story. But I've got some really cool stories over at my new show, The Origin of Things. On this podcast, I look at the stories of how brands came into being and sometimes evolved out of quite unexpected circumstances. And to make it really fun, I reveal the name of the brand and sometimes a category only at the very end. The show is 5 to 7 minutes per episode and perfect for trivia junkies and brand nerds, especially those with short attention spans. New episodes out every Wednesday on IVM Podcasts app or website, or any podcast app or site that you happen to prefer. End of story. They lived happily ever after.